Thursday, November 7th, 2019, Maneco 64, home of alternative economics and contrarian views. Today I want to go over derivatives, the repo market, and how dangerous derivatives are for the system, but how they're also essential to keep manipulating interest rates and precious metals. Before that, I'm going to look at the markets first this morning. There's some headlines here. And you guessed it, it's about the trade wars, right? So that's what's just come out here, London time. It's 7:53 a.m. China says it agreed with U.S. to roll back tariffs in phases. It says on Bloomberg, China and the U.S. have agreed to proportionally roll back tariffs on each other's goods in phases, a Ministry of Commerce spokesman said. So this is a Chinese official, right? The amount of tariff relief that would come in the first phase set to be signed in the coming weeks. So this hasn't even been signed yet, right? It's expected to be in December now. Would depend on the content of that agreement, spokesman Gao Feng said Thursday without giving further details. The two sides had constructive talks in the past 2 weeks, he said. And it goes on to say, if confirmed by the U.S., such an understanding could provide a roadmap to a deal to end the trade war that's cast a shadow over the world economy. China's key demand since the start of negotiations has been the removal of punitive tariffs imposed by President Donald Trump, which by now apply to the majority of its exports to the U.S. So, of course, they would be against all the tariffs, but that's part of eliminating the trade deficit with China, right? I'm not sure this is going to work. So it says stocks rallied with Hong Kong's Hang Seng Index climbing 0.7% and futures on S&P adding 0.5%. The yuan strengthened. And it finishes by saying the two sides continue to negotiate over where and when a phase one deal would be signed. Gao said he had no further information on the location or timing. Of course, President Trump wants to do it at Mar-a-Lago, right? The Chinese probably want to do it at the Wall of China. I'm not sure. So what's going on in the market? So it's just before 8 a.m. The Dow is up 128. It jumped after those headlines. It's down from the highs though. It got up 180, so it's come off. It's up 0.5% at 27,584. S&P jumped to 3,093, so almost 3,100. We're now at 3,087, up 13.25 points, just under 0.5%. Nasdaq 100 future got up to 82.55. We're now at 82.35, so it's up as much as 65. Precious metals got hit a little bit. Gold got down to 1484.70. We're now at 1486.38, down 4. Silver down 7 at 1755. Got down to 54. So yeah, things are quite choppy here early on. Usually the markets are fairly quiet before 8 a.m. London, but this headline has kind of moved things around. I think this is just more hot air, to be honest. So let's have a look at the currencies. Cable is unchanged, 128.50. The euro is up 10 pips or 0.1% against the dollar at 110.76. Dollar yen is unchanged, 108.90. And the yuan is up 1/3, or the dollar is down 1/3% at 698.90. Crude oil benefiting from this. Crude oil is up 0.75%. WTI 56.77, and Brent is up 0.75 as well, just below 62. So that's what's going on in the markets. Let me just have a sip of my coffee here in my End of Fed mug. And the mug says, robbing Americans since 1913, End of Fed, right? At maneco 64. You can get one of these in my Teespring store. It's below in the description or in the banners provided by YouTube. So derivatives. For those of you who don't know, I worked as a futures and options broker for 20 years in the City of London. So those are derivatives, of course. My clients were institutional clients, banks, hedge funds, mutual funds. I had a lot of business in Italy. I did a lot of business in Italy for many years with the biggest funds in Italy, banks, brokers in Italy. A lot of times the brokers and banks in Italy needed access to those futures market, and we gave them that access. So my clientele was, they were professional institutional clients. They weren't individuals. But there's another derivative market aside from futures and options. Futures and options are traded on exchanges. They're public exchanges. Information is transparent on those. But the biggest derivative market that people rarely hear about is the over-the-counter market. And that mushrooms and balloons over the exchange-traded derivatives. Those are swaps, CLOs, all the derivatives that bankers and the hedge funds invent. And basically, counterparties call the derivative dealers at banks and say, I want to build a bet. Basically, that's what derivatives are. They're bets on underlying securities. Recently, we've seen that the former chairman of the CFTC has come out and said that they used the futures on Bitcoin to prick the Bitcoin bubble, right, in late 2017, early 2018. So derivatives are bets. And the most important thing, in my opinion, about derivatives is that they're highly leveraged. So you can put $1,000 down, or let's say, and bet on $50,000 worth of the underlying instrument of the bet, right? So it's even worse than a casino. I highly recommend people watch the movie The Big Short. It's about the 08 crisis, and it explains exactly about derivatives. So just as derivatives have been used to manipulate precious metals down, Bitcoin down, they've been used in the last 25, 30 years to keep interest rates low, right? To make sure that this debt bubble continues. And how do they do that? Well, these derivatives create a false demand for treasuries, for other kinds of bonds, right? It keeps short-term interest rates low because the hedge funds, the speculators, the banks, they get the signal from the central bank, which is called forward guidance, right? And they are saying we're going to keep interest rates low until 2021, so they can go and pile on their trades and make billions, if not hundreds of billions in profit over the years. The only problem with derivatives, of course, is that they're highly leveraged. And what's it got to do with the repo market? Well, before I go onto that, I highly recommend a video by Wolf Richter of wolfstreet.com. I'll put the link below in the description and up in the cards here. It's called What's Behind the Fed's Bailout of the Repo Market. He gives a great explanation of what the repo market is. My explanation is that it's just basically a tap for the people in the casino. It's like where you go to get chips in the casino to put the bets on, right? And it's even worse than a casino because you can go with $10 and get like $100, right? In the casino, you put $10, they give you $10 worth of chips. So the repo market funds not only the banks on Wall Street, but the shadow banking, as Wolf Richter talks about. These are private equity firms, hedge funds, mutual funds, any kind of financial institution that leverages themselves, they need the funding. Why do they need the funding? Well, because they're greedy and they want to leverage the assets they have, right? So an example would be, let's say you have $1,000 worth of treasury bills, right? You hold that, and you're not happy with the 2% return you're getting annualized per year or per annum. So you go and you use that as collateral to borrow $1,000, right? But then you take those $1,000 and you put it in the COMEX or in the CME, and you speculate in 20,000 or 30,000 worth of futures or options, right? And that's how you leverage. So you're not happy with your return, and this is normal. The low rates that need to keep the system going, they've kind of had the effect that people need to leverage more and more to get the return, and that's what the repo market is all about. Also, the derivatives is even more important. In the '08 crisis, the notional amount of derivatives, which is the size of the bet that you put on, was over 1,000 trillion or a quadrillion dollars, which is huge. The other thing about these derivatives is that they're all kept off balance sheet. We have the OCC, which is the Office of Controller of the Currency. They publish a quarterly derivative reports on the OCC.gov website, and you can see here, this is all off the balance sheet, but it's kept track of by the OCC. It says here, second quarter 2019 national amounts of over-the-counter and centrally cleared derivative contracts, right? So let's have a look who's got what, right? JP Morgan has got 67.8 trillion in derivatives. Citibank has got 47.5 trillion. Bank of America 22.6 trillion. Goldman Sachs 41.6 trillion. HSBC 5 trillion. Wells Fargo 11 trillion. So the major banks, American banks, holding companies have about 200 trillion. Why is it not a quadrillion anymore? Well, it is. The BIS allowed the derivatives market or industry, if you want to call it, to change the way they calculate the notional amount. So it underestimates. Many people think it's still over a quadrillion, and this doesn't include other foreign banks who trading these things as well, other international banks, too big to fail banks. But you can see there, it's all here. Let's have a look at how important these things are for interest rates, right? So here we have derivative contracts by type. So the blue bar is interest rate. So you can see how important it is to manipulate interest rates, these derivative contracts. You've got foreign exchange, equities, commodities, and credit derivatives. So there you go. Gives you an idea how important derivatives are to keeping this charade of artificial rates out there. And here's the other one that I wanted to show you. Notional amounts of precious metals contracts by maturity insured U.S. commercial banks and savings association. Why would U.S. commercial banks need to have so much exposure to precious metals, right? You would have thought. But look how it's increased. Look how much they need to create false supply of precious metals, right? That's the manipulation there. This chart goes back to, let's have a look, 2001. It went from 2.5 billion approximately. Now it's up to almost 40 billion of notional amount of derivatives. So you kind of wonder, how can they have a quadrillion of notional amount? Isn't that risky? Well, it is risky. What the bankers always say is that they can net off against the other counterparty. They only need to pay them the difference or the profit on the position, right? There's always two counterparties to a derivative, right? So if you buy a interest rate derivative and in 6 months you've made a profit of $100 million, the other counterparty is supposed to send you that $100 million so you can close out the position and you get $100 million profit. They have to pay the $100 million. So they always say it nets out. The only problem with it is when the counterparty goes bust, right? There's counterparty risk. That notional amount becomes real. And that's what happened in '08 when Lehman collapsed, when AIG financial products put AIG in the brink of collapse. AIG financial products actually insured these derivatives contracts. It's crazy, right? So that's what I think is happening. The repo market is kind of the source of funding for these derivatives. What it's telling me, in my opinion, is that these derivatives are getting crazier and crazier, even more leveraged, and people in the markets don't trust each other. So the Fed had to come in to keep this charade going. So I think it's going to get even more dangerous. We could see even more accidents out there. So to finish off, I'll just show you Exter's pyramid. John Exter, of course, you can Google him and you find him on the Wikipedia. There's a lot about John Exter. He used to be a central banker, used to work for New York Fed in the 1950s, and he talked about how gold was at the tip of the inverted pyramid of credit, right? Back when he was around, derivatives weren't that big. Derivatives have only grown, really, these financial derivatives have only grown with the advent of fiat money back in 1971 when Nixon went off the gold standard. And why? Well, because they need to keep a false demand for this crappy paper, for the bonds, right, which are created out of thin air. So this is like an updated version, so to speak, of his inverted pyramid, and you can see that derivatives are right at the top. And I think that top of the pyramid is starting to crack, in my opinion, and that's why the Fed had to intervene. Gold, of course, is real money. You could add silver there as well. This one doesn't have silver. So that's what I think is happening. We're not out of the woods yet. Keep an ear out about the repo market. Derivatives, of course, you won't hear on CNBC or Bloomberg or the financial press them talk about this. They're not going to talk about the fact that derivatives are what keep the system going. One little story that I remember when I worked in the city, probably back around 2010, 2011 or 12, when things were not going great for the European government bond market, when the crisis in Europe started, the sovereign bond crisis, right? We heard that one of the big hedge funds, and I'm not going to use names here, but it's probably the biggest hedge fund in London. The guy who's behind it, we heard stories that he'd gone to Frankfurt to meet the ECB, right? So you kind of wonder, why would a hedge fund manager have to go to Frankfurt to meet the ECB? Well, probably because the ECB was going to give him a heads up. Look, we want to keep interest rates low. So what would this hedge fund do? Well, they go into the derivatives market, right? And buy massive amount of futures, or they'll do over-the-counter derivatives, right? And make billions. But at the same time, drive the market to where the central bank wants to the market to go, right? So there you go. Derivatives, repo, it's a big toxic cocktail And it's the reason why they've been able to keep this game going for so long. Jim Ricketts has said that derivatives need to be banned, right? They probably will once the system implodes. It's what keeps it going. Ask any questions you want in the comment section, and I'll try to respond to it about derivatives. I know it's not a simple thing, but yeah, let me know if you have any questions. If you enjoyed this video, make sure you hit the like button. Subscribe to the channel if you haven't yet. Make sure you also hit this little notification bell above here to be notified of all my new videos. I make a video every day. It looks like YouTube is not notifying people, so you got to look for my videos if you don't see them pop into your YouTube page, right? And you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.